So do you think that the U.S. is facing stagflation?
We're headed toward it, yeah.
We have a market today which feels superficially like 2000.
We think we're in a monetary inflation, which is a very different animal than what we've experienced in the last couple of decades. Recent inflation has a cyclical inflation is when you get a pop in the economy, pushes up against capacity constraints, inflation goes up. But money and credit are under control. This is a monetary inflation more like the 70s. It was triggered by the massive injection of money and credit by policy, which has now created a self-reinforcing process. Very high levels of nominal spending, 10% nominal GDP growth. I mean, it's a long time since we've seen high nominal GDP growth, right? So there are things happening now that people are not used to because we haven't seen these dynamics for a long time. But the result of a monetary inflation is high nominal GDP growth, and then that gets absorbed by prices, and so you get low real growth.
Right.
And that produces stagflation, which creates a very difficult policy choice.
So do you think that the U.S. is facing stagflation?
We're headed toward it, yeah. Now how do you define stagflation? There'd be different ways, but basically the way we look at stagflation is in terms of how it affects markets. And the way it affects markets is if the inflation rate is higher than discounted and the growth rate is lower than discounted. And we're in a situation right now where there's a very low inflation rate discounted, therefore it's easy to be above that, and we've got a high growth rate discounted, therefore it's easy to be below that. So relative to what's discounted, we could very easily be into this very quickly.
We have a market today which feels superficially like 2000, and I think it's going to play out initially like 2000, and then unfortunately is going to phase, as he suggests, into the 70s, where the deflationary effects on the economy and the stock market will result in a world rather like the 70s, where all assets are simply much lower priced than they are today. A word on inflation too. I completely agree with Ray on short-term problems, which I would summarize as monetary and general Federal Reserve overstimulus for 35 years. The war and COVID, all of those three influences guaranteeing that we have relatively intractable problem in the short to intermediate term. What worries me is the longer term arguments for inflation, which is one, we are running out of people. In China, where the 500 million extra farmers precipitated globalization, they have now had diminishing cohorts of 20-year-olds for 20 years, and they are guaranteed, since they're alive now, we know the baby cohorts are dropping like a stone. They are simply going to have a shortage of labor, as is the developed world together. That is not a trivial block, the developed world plus China. All of them will be squeezed for labor. After the bubonic plague, they had a 100-year honeymoon period in which wages went up so much it wasn't reached for another several hundred years in the Industrial Revolution. And we are entering a period where labor is simply scarce, which feels to me inflationary. And at the same time, we have a scarcity beginning in resources. And we keep an original, unusual index at GMO. It's 36 equal weighted important, the most important commodities. So it's not dominated by oil. And it showed a declining pattern for 102 years, from 1900 to 2002. And yes, it was interrupted by World War I and World War II and OPEC. Why wouldn't it be? But it wanted to go down. It went down 70%. It took the index down to 30. Today, 122 years later, the index is down 10%. It has gone to 90. The average important commodity has just spent the last 20 years going from 30 to 90. It has tripled. The reason is, of course, the growth of China, but I believe, fairly passionately looking at the data, that it also represents the intrinsic scarcity, the war between deeper wells worse iron ore, etc. The best go first. The struggle is always between technology, which for 100 years got ahead of scarcity. It was 2 paces down for deeper and 3.5 paces up for technology. And now we've reached a phase where we've gone through that stuff. And now we have 2 paces up for technology and 3 paces down for scarcity. The data is screaming at us now for 20 years that we're beginning to run out. It doesn't, and a war, of course, and COVID, we're so fragile. All you have to do is cough now, and it ricochets around the world in price spikes and shortages and bottlenecks. And that is the world we better get used to living in. We're going to have a world of increasing number of bottlenecks and shortages. And the same applies to food. The UN Food Index is higher today than any time in its history of the last 50 years, since it started. Okay, so you have price pressure on raw materials, metals, food. You have price pressure long-term on labor. This surely feels like a new era in which inflation will be part of the background music, just like it was in the 20th century, and perhaps more so. The risks of a debt bubble breaking and the risks of an equity bubble breaking have simply not been understood by our Federal Reserve since Paul Volcker. They are incredibly naive. They haven't even got a clue. They're not even interested in the idea. The idea, Bernanke saying, oh, the US housing market has never declined. It merely reflects a strong US economy. Alan Greenspan encouraging, et cetera, right through until today. They don't realize that they're playing with such fire. My second point, high levels of debt are just far too often seriously dangerous and should be, in general, discouraged actively. That should be one of the responsibilities of top management, including the Fed, et cetera. And let me just give you an example. Why do you like low rates? Because it encourages debt. Why do you like more debt? Because it encourages growth. That's the argument. So let me give you the ultimate statistical test of that. We start in 1985, and we have been modestly increasing the debt to GDP ratio, all debt together, just drifting slightly up due to technology. And then the technology, I mean the introduction of more and more sophisticated financial instruments, but not rising dramatically. And then in 85, it kills to a 45-degree angle and shoots across any page and goes from about 1.1 times GDP to well over 3. So in that little window of 35 years, we triple the debt to GDP ratio. It's a big chunk of time. It's the biggest, most important economy on the planet, a pretty good test. So what happens to growth? It inflects downwards. And from 85, we grow more slowly. Grant you, there are many other factors at work. It's a complicated picture, but there is little room in that equation for the idea that more debt creates more growth. It is not proven in the data. It is held to be the case. It is an assumption like most of modern economics, but it is not proven by the data. I would suggest that there is no evidence at all that increased levels of macro debt to GDP have anything to do with growth. They have everything to do with higher risk that will come down.